Welcome to Investors Guide. Thank you so much for tuning in. Remember, we're here on this show to help you with whatever you need when it comes to managing your money. All of the advice you hear on the show is designed to help you pick the right product. So if you have questions about something you'd like us to address or a particular problem that you're facing, feel free to get in touch with us. Our email ID is at the bottom of your screen. You'll also find a copy of our show on our Facebook page. You can like that page and get regular updates of what we're doing. And of course, you can get in touch with me personally on Twitter. On the show this week, we'll help a 23-year-old self-employed young man manage his finances and look after his family. In our product review, we look at the Reliance Top 200 Fund. And we'll help investors understand what tax you'll have to pay if you invest in international funds. All right, it's time for me to bring in Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for joining us. Before we start answering questions, there's a question that all investors are going to be asking at this point. Debt funds are not doing well. Gold is not doing well. Real estate, we know, is a really weak market. It's been so for a while. And now the equity market is volatile. It does seem like all asset classes right now are subdued. If I were to ask you personally, which asset class would you be betting your money on? Which one would that be? Would it still be equity?
Of course, for my long-term investment, it will still be equity. And in fact, I'll stick to my plan. And I'll be quite pleased with, all this turbulence because I'll be able to buy it lower. And of course, I will be, the whole turbulence or the volatility right now, it just emphasizes one thing, that why one should diversify. Because if you recall, just about a month back, we had the dominance of question where investors were asking which is the best mid-cap to buy. And I think all this volatility drives home the point that you should diversify. You should have everything. And you should not get one-sided, when it comes to asset allocation broadly, equity and debt. And at the same time, within the asset class, something which was doing exceedingly well, things turn around when you least expect it. And that is what we are witnessing right now.
So always remember to use an SIP, use a diversified equity fund. And if you have questions about which fund you should be using in particular, you know how to reach us. Email ID is on your screen right now. Let's move on to our portfolio question. All right, Ankur Chaudhary has written in the range. He's 23 years old, self-employed, which I think is the interesting and the important piece of information in his question. He makes an average monthly income of 50,000 rupees, and it does seem like he's handling his money really, really well because he has 2.5 lakh rupees in his savings bank account that can function like an emergency fund. 1 lakh rupees going into his PPF and about 30,000 rupees in his fixed deposits. He wants to now increase both his health insurance and his life insurance and increase his PF contribution as well. And he'll start investing in mutual funds, he says, from this year onwards. But here's the interesting thing. He has managed, of course, to take advantage of the Pradhan Mantri Jeevan Bima Yojana and, of course, the Suraksha Bima Yojana, one of which, and this is open to all of us as citizens, the Suraksha Bima Yojana is an accident insurance policy for 2 lakh rupees, and all it costs is 12 rupees a year. And the other one, which is the Jeevan Bima Yojana, is a life insurance policy of 2 lakh rupees that costs 330 rupees a year. And all you need really to buy these insurance policies is a bank account, and you have to sign a little bit of a form. So it's so impressive that someone this young has managed to take advantage of this policy, hasn't it, Narendra?
Yes, absolutely. I think, he is quite a lesson for most other people because if you can't afford any insurance, or if you don't know which one to buy, this is something worth going for, and it is a baseline insurance. Every Indian should go for this, and it costs less than it costs precisely 342 rupees, and you get accidental coverage of the minimum kind. And if you have no dependents, I think this is a good enough insurance to go for anyway, because this is virtually free. And most other people, who are unable to squeeze in their allocation to insurance, I think this can come in very handy because these two coverage will provide you limited, not good enough. But for this price, something is better than nothing, and one should look at it.
All right, so, the interesting part is even if you feel that you don't need such a small insurance cover, the more of us who sign on, it helps the government open up that cover to more and more people. So the numbers are important as well. So 342 rupees is all you need for a 2 lakh rupee accident and a 2 lakh rupee life insurance cover. Let's look at Ankur's case in particular, Narendra. He should, of course, get health insurance for his entire family. So consider getting a family floater plan. And for yourself, you need a life insurance, a term cover, of 10 times your annual income. But we are very proud of the way you're managing your money. Narendra, he wants to invest his money. He says over the next 3 years, I would like you to consider a longer time horizon. He's looking at UTI MNC, UTI Transport and Logistics, Franklin India Smaller Companies, Franklin India Opportunities, Axis Long Term, Reliance Tax Saver and SBI Magnum Balanced Fund. What would you recommend he does? Can we trim that down and give him one of our own portfolios instead?
Yes, our aggressive portfolio, will help him achieve diversification. Will provide a method, and it will also, and we will be periodically review for him. So that will also be a handy guidance embedded into the whole plan. But before that, something which crosses my mind about his, he's very methodical. That's very impressive. He has also approached insurance in a very novel way, which is interesting. But I really want him to reconsider his 100,000 rupee, 1 lakh rupee contribution to PPF, because somebody who is so methodical, approaching things methodically, I would think that his long-term allocation into tax-saving fund should be into a tax-saving fund, because long-term fixed income will be a huge disadvantage. And if one is availing the ATC benefit to the tune of 1.5 lakh rupee, PPF for somebody who has understood and has been able to comprehend things at such an early age, that tax-saving fund itself will ensure that he will be well off.
All right. One very quick question, Narendra. For someone who does not have a regular monthly income or doesn't have a fixed monthly income, he wants to put aside 60,000 rupees in mutual funds. So ideally, we would have told someone with a salary to pick an SIP. But if I'm not sure about the money coming in, what is the best way to handle that sort of a thing?
No, the best way to handle such a thing is just have a larger emergency fund. Don't invest for first 2-3 months. In your case, because you have less periodic or more income which is less predictable, you don't get your salary on 1st of every month, but you do get your revenues on some cycle. So maybe have a larger emergency fund and just treat yourself as a normal employee of your own business.
All right, so we hope that helps. Now, I'm going to put our aggressive portfolio on your screen one more time. This is the one that Narendra recommends for you, as opposed to the ones that you've shortlisted. It will serve your purpose better. And do, of course, try and invest for longer than just 3 years. Our aggressive portfolio is meant for someone your age with the assumption that you'll stay invested for at least 20 years. We'll review the funds on this show on a regular basis. All right, before we go into break, remember, we started a brand new segment called Beginner's Guide 2 weeks ago. It's back again this week. Now, up till now, we've taught you how to do your KYC, how to buy a mutual fund online. This week, how should you open a Demat account? Krishna is standing by with all of the details. Krishna.
Thank you, Faye. Last week, we told you how important it is to have a Demat account, but what we didn't tell you was how to get one. So without wasting any time, here's how you do it. First, select a depository participant that you want to have a Demat account with. And by that, I mean any brokerage or financial institution. Go to their website and fill in your name, email ID, mobile number and PIN code details and sign up, after which they will send a representative to your premises. Meanwhile, keep photocopies of all your supporting documents for proof of identity, proof of address, along with a passport-size photograph as well. Remember, whatever you choose to provide, make sure there's a copy of your PAN card. That's a must. When the representative arrives for your in-person verification, you would need to provide all of these along with the original documents as well for cross-verification. Make sure you read the fine print, because as a Demat account holder, you would need to pay some kind of fees like an annual maintenance fee for your Demat account or the transaction fee levied for debiting securities to and from your account. And it differs from service provider to service provider. And keep in mind, a Demat account does not require that you maintain any minimum balance of shares. Happy investing, and back to you, Faye, in the studio.
All right, Krishna, thank you for that really quick class. Welcome back. You're watching Investor's Guide in ET now. Narendra Kumar is still with us. It's time for our product review. This week, we're looking at the Reliance Top 200 Fund. Avan will give you the numbers first, and then we'll come back and talk about it. Avan.
Thanks, Faye. Let's take a look at the Reliance Top 200 Fund this week. The fund's performance has been above average with an annualized return of 11% since its launch in August 2007. Here's the fund's performance graph. The blue line is the fund and the red line is the benchmark, the BSE 200. Now, although the fund has outperformed its benchmark and its category average in its existence of 8 years, it doesn't really stand out on the performance chart. in a rising market, that too. However, you'll notice that the fund has performed well in weak markets with its ability to restrict its fall compared to its peers. The trailing returns shows us that the fund has outperformed its category in the 1, 3, 5 and 7-year periods. In the year 2012, the fund was ranked the best in its category with a return of 41%. On the other hand, the fund underperformed its category the following year. In the last 1 year, however, the fund has still lagged behind its category peers with a return of 18%. With a clear focus on mid and large cap stocks and above average performance in its 8-year time horizon, should this fund feature on your portfolio? Let's find out. With that, it's back to you, Faye.
Narendra, there's still 1,230 crore rupees assets under management in Reliance Top 200 Fund. Would you recommend all of those investors stay invested in this fund?
It is quite a mediocre fund, and I think about 4 years back, this fund changed its character. Not its character, its name as well as its attribute. Earlier it was called Equity Advantage Fund. Now it has changed to be a Top 200 fund and invest in a large portfolio, large universe. It has available, and the stated position is that the fund can invest in any stock, which fits between the largest and the smallest company in the BSE Top 200, BSE 200. So that makes it a large universe, and the fund has done well. It has beaten its benchmark on a 5-year basis, but relative to many other options which investors have in this category, which is the large and mid-cap category, and I think this is a very mainstream category. This is the kind of fund which most investors should be completing their portfolio with. If you have 2-3 such funds from such category, you get a broad market exposure. They are very low maintenance approach to investing in equity. So in this category where your investors have great options, this is very firmly settled as a mediocre, middle-of-the-road fund.
All right, finally, Narendra, what's your rating of the Reliance Top 200 Fund? Where would you place it?
I will assign it a 3-star, and that is where it gets slotted on a risk-adjusted scale too.
On your screen right now are multi-cap funds that Narendra has recommended on this show, all of which would be a smarter alternative to this fund if you're holding it in your portfolio. Narendra is saying that it's a decent performer, but it's middle of the pack and there are better options in the market for you. Let's move on to our hold or sell segment. Rajat has written in, Narendra, he wants to create a corpus of 2 crore rupees over the next 15 years, which is amply doable. He's currently investing about 10,000 rupees a month in 7 mutual funds with the understanding that he will increase his contribution as his salary increases. He wants to know if his is the portfolio that will take him up to 2 crore rupees. So I'm going to combine a couple of funds so that we can take them together. He has the Franklin India High Growth Companies and the Franklin India Smaller Companies funds. Both of these are strong performers. Does he need to have both in his portfolio?
High Growth Companies Fund can have all kind of stocks which has the potential to grow rapidly, whereas the Smaller Companies Fund will have only smaller companies. So in that sense, the common part of the portfolio or the complementary part of the portfolio is not, there isn't a big overlap. So he can well carry both, and both are approaching the both will help him achieve his goals of aggressive growth in different fashion.
Well, the next on his list is the Canara Robeco Emerging Equities Fund, Narendra. Continue with that fund as well?
Yes, this as well, and looks like he has done his homework. All the 3 funds have done reasonably well, fairly consistently.
Next on the list is L&T Infrastructure, Narendra. It's a thematic fund, and I know you frown a little bit on infrastructure funds altogether. Should he continue this investment?
No, I'll continue to frown. And this is something which which has been disappointing, and there will be a time when infrastructure funds will do well again, but I think the wait can be much longer, and investors are not, particularly about infrastructure fund, I think investors are not deprived of any opportunity when they are investing in any other kind of diversified vehicle. Then there isn't a point in constraining yourself by sticking to an infrastructure fund.
SBI Blue Chip is the next on his list, Narendra. Continue that investment as well?
Yes, this fund has actually come to life as a large cap fund, and been very impressive in the last few years. It has found its way into one of our core, mainstream recommendations. Yes, a great fund to have.
ICICI Prudential Banking and Financial Services, another reason to frown, because most of our diversified equity funds are so are so exposed to banking and financial services anyways. Is there any particular need to get a specific fund?
No, absolutely not. In fact, you have said the reason. Not only that, just to reinforce the point that our index itself has about 33-34% allocation to banking. So all our funds, if they are naturally spread or if they are benchmarked properly, a third of your money in most other funds will be into banking and financial services. So there isn't a reason why one should be, and why you should have a specialist fund like this, a sector fund like this. And if every fund manager has a discretion to have underweight or overweight in a reasonable range, so the fund manager will take care of it. Particularly this particular sector, I don't see any reason why any investor should have it over and above their other general equity funds.
Last on his list, Axis Long-Term Equity, Narendra. What's your verdict on this one?
No, this is an outstanding tax saving fund and an outstanding equity fund. He should have it, and just ensure that, my suggestion to Rajat will be that ensure that you are able to fully utilize your ATC allocation with your tax saving fund, and that allocation has gone up to, the benefit that you can avail every year is up to 1.5 lakh rupees.
All right, so there's your list, and if you have any more questions, you can get back in touch with us. That's what we're here for. We're always here to help you. Narendra, very quickly, before I let you go, Rahul Bhagwat has written in. He's 32 years old. He has a 2-year-old daughter. He wants to put aside 10,000 rupees every month for her. He says, please give me a mix of equity, large cap, mid caps, and global funds for my goal. So effectively, what he's asking is which of your portfolios will suit his benefit. So he has a long-term horizon, 10K a month. Which one should he be using?
No, for somebody who is investing for his 2-year-old daughter, which means that it's nearly 16, 18 years, he is unlikely to need that money even for the basic serious education once she gets into. My suggestion will be go for our aggressive growth plan and knock the fixed income allocation from that. So it will get even more aggressive without that allocation, and you will be freed from that bother of rebalancing it off at any periodicity. So go with our aggressive growth plan with confidence.
All right, our aggressive growth portfolio is on your screen right now. Narendra, thank you so much for answering our questions this week. It's always such a pleasure to have you on the show. Remember, if you have questions for Narendra, this is the fastest way to get them answered. Write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide in 80 now. Thank you for staying with us. We brought in Suresh Surana to answer your tax-related questions. Suresh, thank you for joining us. Our first question comes in from Prakash, and Prakash has quite a few problems with his taxes. He switched jobs in 2012, and in that particular financial year, he tells us the new company he joined deducted TDS from his salary but didn't consider the previous earned income. So all in all, there was about 22,000 rupees that he is not paid in income tax for that year. He also did not file his taxes that year. So now he has a tax liability to pay. He has to file his taxes for that year of assessment, and he wants to know how he can do that and what sort of penalties he's going to have to pay. So it's not impossible. It can be done. How does he have to do it?
You should have informed your new employer about the salary which you have drawn from the previous employer as well as the tax deducted. Since the new employer did not know about the previous salary income and the previous tax deduction, there would be a lower tax deduction because of the basic exemption as well as the lower slabs of income. So now what you need to do is to pay the balance amount as the self-assessment tax. And since the amount is more than 10,000 rupees, you will be liable to pay interest under section 234B and C at the rate of 1% per month. Of course, there is no penalty for this. As long as you pay the tax and you pay the interest on that, you will be fine.
Our second question comes in from 32-year-old Senthil, who works for the central government. He tells us now in 2015-16, he's altogether invested 87,000 rupees in the NPS, including the government contribution and his own contribution. He wants to know, can he claim his deduction under 80CCD and under 80C? So split up that across two. How will he claim the deduction for this year? Suresh.
Yes, so Mr. Senthil, now under section 80CCD, there are two parts of it. One, there is newly amended section 80CCD subclause 1B, which in the last Finance Act now, they have given an additional deduction of rupees 50,000, which you will be able to claim. As far as the remaining 37,000 is concerned, the deduction is not under section 80C, but it is under section 80CCD subsection 1. And there the limit what you can claim, the maximum deduction, is also restricted to 10% of your salary income. Also the total deduction under section 80C, 80CCC and 80CCD1 put together cannot exceed 1,50,000. So you have to see that apart from 50,000 what you will definitely get it as a deduction, remaining 37,000 is subject to these conditions. Under section 80CCD subsection 1 you can claim the deduction.
Last question comes in from Shiva, who recently began investing in international funds. He says these funds are registered in India and he's an Indian citizen, so what sort of tax is he going to have to pay on these funds? Suresh.
Yes, so Mr. Shiva, as far as in case you are investing in a fund which is registered in India, then the units which you are holding are assets in India, even though that fund may be investing outside India. So you do not have any obligation to report those assets in your tax return as foreign assets, nor do you need to report to RBI. But if you are investing in a fund which is registered outside India, in that case you will have to report your foreign assets in the form of investment in that fund, as well as for making the investment you need to do in accordance with liberalized remittance scheme of FEMA or any other applicable scheme to you, and you need to do those compliances under FEMA. So you need to check whether the fund is actually registered in India or is it registered outside India. Based on that, these compliances will be done.
All right, Suresh, thank you so much for answering our questions. That brings us to the end of Investor's Guide this week. Remember, if you have a question about a tax problem or anything else, you can get in touch with us. Our email ID is at the bottom of your screen. Reach me also on Twitter. It will be my pleasure to hear from you. Thank you so much for watching.